Good morning and welcome to this deep dive. We're digging into the Bills, Bears, and the Bell Morning Edition brief for September 30th, 2025. And what we're seeing today is a market that seems poised, but honestly deeply conflicted.
That conflict really is the key takeaway. And our mission here is to, distill that conflict for you. We're not just looking at the surface numbers. We're tracking this fierce, kind of strategic tug of war.
Okay, so what are the two sides pulling?
Well, on one side, you've got the micro, these really strong individual company stories, specific catalysts like earnings or M&A news. But then pulling hard the other way is the macro, these big imposing headwinds like political uncertainty, key economic data coming up, global stuff too.
And the whole day, maybe the whole week, hinges on which side has more pull.
Exactly. Which force dominates? Right now, U.S. stock futures point a little higher, suggesting maybe the micro side is trying to gain some ground.
Yeah, seeing a bit of that risk-on feel, trying to bounce back from last week's losses. And tech seems to be leading, again, no surprise there. Indian Tech 100 futures up around, 0.6%? S&P 500 maybe 0.5%?
But that optimism, it happening despite these two massive macro worries lurking. The first and the most immediate one is the political threat. The U.S. government shutdown that could kick off as early as Wednesday.
Wednesday, okay. But the market seems to be trying to ignore it.
It's attempting to, yeah. It's really interesting. We see some evidence for that trying to ignore it attitude in the bond market, actually.
Okay, so tell us what the debt market's signaling here.
Well, yields are easing slightly. The 10-year Treasury, the big benchmark, it's pulled back to around 4.15%. When yields fall like that, it tends to help risk assets, especially those growth and tech stocks.
Right, because higher yields pressure their valuations. So a move back down is supportive.
Precisely. A move back up, say towards 4.20% or higher, that would be a real drag. So this pullback is providing some critical support. And also the U.S. dollar index is a bit weaker, around 97.89. That usually helps equities too.
So the narrative stateside seems to be, okay, shutdown's probably coming, but maybe it's just noise, not a systemic crisis. But is the rest of the world buying that? Are international investors feeling as confident?
Not quite so much. Global caution seems heavier overseas. Trading was pretty mixed, kind of guarded. Asia was split, Japan down. South Korea managed some gains.
In Europe.
Europe's trading cautiously, too. FTSE 100, the DAX, both down a bit. You can tell their sentiment is being weighed down by this U.S. political drama. They seem less willing to just bet on a quick, clean resolution.
Okay, this brings us to what feels like the most, fascinating contradiction in the sources today. Because if the U.S. market really thinks it's risk-on, driven by tech strength, shouldn't other assets align with that?
They should, yes.
But you're not. Why are safe havens like gold spiking at the same time stock futures are rising? This is where the simple story kind of falls apart.
It really does. And this divergence, it makes you pause because it just screams underlying anxiety, doesn't it? You've got stock futures pointing up, suggesting optimism, and yet gold is surging. Not just up, but surging to record highs near $3,850 an ounce. That's a huge move. Betting on growth and survival at the same time, that feels fundamentally contradictory.
I get hedging, but a record gold price, isn't that just totally incompatible with tech stocks leading the way higher?
Sure.
Is this just smart institutional hedging, or is it like two different markets operating in bubbles, the macro guys versus the retail spec traders?
That's the perfect question. And the data, well, it suggests it's this really nuanced, almost split personality trade, probably driven more by the bigger institutional players. They seem to be making two very distinct bets.
Okay, bet number one.
Bet number one is the short-term, low-impact bet. They're thinking, okay, if the shutdown happens, it'll likely be brief, politically driven, maybe not have a huge long-term hit on company earnings. So they hold on to their stocks or maybe nibble a bit.
Makes sense. And the second bet, the gold bet.
That's the hedge against the absolute worst-case scenario. Systemic risk, a big policy mistake from the Fed or someone, maybe an inflation spiral kicked off by fiscal chaos. Gold hitting $3,850 isn't just a little hedge. It's a major statement about a deep lack of confidence, maybe in government stability or currency value long-term.
Wow, so it's the ultimate disaster insurance, bought while simultaneously betting the immediate storm won't be too bad.
Exactly. It's hedging against tail risk while hoping for the best in the near term.
And the VIX, the market's fear gauge, seems to back up this layered anxiety, right? The spot VIX dipped, which matched that surface column you mentioned.
Right, the spot VIX is down a bit.
But you have to look at the futures.
Precisely. VIX futures are already trading higher, up around 17.87. And that's key because VIX futures show what traders expect volatility to do down the road.
So they're pricing in future fear.
Yeah, that 17.87 level suggests they expect hedging costs to rise in the coming weeks, specifically tied to that political timeline, that Wednesday deadline. If we see the VIX futures push sustainably above, say, 17 or 18, that's the market officially saying, okay, now we're pricing in serious disruption risk.
And even in commodities, which should reflect real-world stuff, we see mixed signals, like WTI crude oil futures are down.
Yeah, WTI crude's down to around $63, $64 a barrel. There's talk about potential OPEC plus output increases maybe weighing on it.
Which is kind of a deflationary signal, right?
Yeah.
Suggests maybe worries about global growth.
That's a key interpretation, yes.
Mhm.
Falling oil can suggest skepticism about future demand, maybe concerns about economic slowdown. So you've got gold flashing the systemic fear, stocks showing some confidence in company earnings, and crude oil hinting at global growth worries. It's a very messy picture. Lots of contradictory bets happening.
Okay, so despite all that macro fear, the gold surge, the VIX futures ticking up money is clearly still flowing somewhere specific, somewhere aggressive. Where are those speculative animal spirits really showing up today?
Oh, they're definitely showing up, mostly in the really volatile small cap end of the market. And they're using this surprising new angle, what the brief calls the crypto treasury play.
Crypto treasury play. Okay, let's unpack that. That sounds...
It is. We saw two huge pre-market movers. Maison Solutions, ticker MSS, was up almost 295%. Predictive Oncology, POAI, up nearly 175%. Just massive jumps.
Wow, what was the catalyst? A drug approval? Earnings?
Nope, neither. The catalyst for both was announcing they'd secured private funding, private placements, specifically to launch these things they're calling digital asset treasuries.
Digital asset treasuries. What does that even mean in practice?
It means they're raising money, essentially speculative capital, not to, build a factory or pay down debt in the traditional sense, but to buy, hold, or somehow use highly volatile crypto tokens in these cases, WorldCoin, WLD, and Ether, ATH, as part of their corporate treasury.
So they're putting crypto on the company balance sheet with this new money.
Seems like it. It's a really high-risk gamble, basically leveraging the hype and allure of crypto to get funding. It signals some serious froth in certain corners of the market, right? Where maybe fundamentals are taking a backseat to just pure catalyst excitement.
Definitely sounds like froth. And while some of these names are soaring on that crypto angle, the pre-market is also acting like judge, jury, and executioner in biotech, isn't it?
Yeah.
Absolute split decision there today.
Oh, completely. It's binary, all or nothing outcomes getting priced in instantly based on one piece of news, usually trial data.
Who was the winner today?
The winner was Dogwood Therapeutics, DWTX. Stock surged over 50%. They secured a worldwide license for a cancer-related pain treatment. That's huge validation.
Okay, good for them. But then the flip side, brutal.
Absolutely brutal. Kaela Bio, ticker Kaela, just plunged. Over 92%, almost wiped out. Their phase 2B trial failed to meet its main goal.
92%, wow.
And at the same time, Biotech, IOBT, fell nearly 80% after getting some unfavorable news from the FDA. It just shows you the nature of that sector, right? One data point can just vaporize almost all of the company's value overnight. Really underscores that high-stakes catalyst theme.
And we should quickly mention another big pre-market loser, Beyond Meat, BYND, down over 50%.
Yeah, BYND down huge, about 55%. They launched this complex debt exchange offer, trying to get rid of over $800 million in debt. So yeah, across the board, crypto speculation, biotech wins and losses, debt restructuring, the theme is extremes. No middle ground.
Okay, let's shift to corporate earnings then. The brief highlights a really key learning point here for anyone analyzing results right now. This idea that the market is priced for perfection.
Exactly, priced for perfection. And that changes everything about how earnings are received.
And when you're priced for perfection, the bar for success is just impossibly high, isn't it? Looking back at great results just doesn't cut it anymore. It's all about what's next. Carnival Core CCL seems like the perfect, maybe painful example of this earnings paradox.
It's a fantastic case study. I mean, CCL reported a genuinely stellar Q3 2025. Record revenue, $8.2 billion. Record net income, $1.9 billion. Their earnings per share beat estimates $1.43 versus the $1.32 expected. By any historical standard, that's a blowout quarter, a great sign for the cruise industry's recovery.
Huge numbers. record numbers. Yet the stock reversed course and closed down almost 4% the day they reported. So why did investors just shrug off those amazing historical results?
It really boiled down to the forward projection, the guidance.
Right.
That small beat on the actual results was completely overshadowed by what they said about 2025 net yield growth.
Net yield growth. Remind us what that is again for cruises.
Sure. It's basically the revenue they generate per available cruise day. It's like the core measure of their pricing power, how much they're making per cabin.
Got it. So what was the disappointment there?
Well, Carnival projected 5.3% net yield growth for 2025. Now, 5.3% sounds pretty good, right?
Yeah, seems solid.
But it was slightly below what the really optimistic analysts were hoping for. The consensus estimate was closer to 5.79%. Analysts had basically priced in almost 0.5% more revenue growth based on booking trends and how much they thought Carnival could raise prices.
Okay. So when management came in at 5.3%, even though it was positive, it was seen as a slight derating, like maybe future growth won't be quite as spectacular as hoped.
Precisely. It signaled that maybe future execution might be just a little less flawless than those very high expectations baked into the stock price.
So in this kind of market environment, just beating the last quarter isn't enough. You absolutely have to deliver a clean beat and raise, beat the results and raise your future guidance. Otherwise, you risk getting punished.
That's exactly the dynamic. And we saw it elsewhere, too. Jefferies Financial, JEF, they also beat Q3 estimates. Their stock traded down about 1.8% afterwards. Same muted reaction. The only one really rewarded was Progress Software, PRGS, because they delivered that clear beat and raise. Stock went up.
The message seems crystal clear then. The market demands impeccable forward execution, not just past glory.
Nailed it.
And that intense focus on what's next brings us right to the data gauntlet this week. The second half of the week looks absolutely crucial for economic data, stuff that could immediately reshape the whole narrative around the Fed, inflation, growth, everything.
Yeah, the calendar gets heavy starting Tuesday. We get the Jolt Tech job openings report. Consensus is looking for somewhere between 7.1 and 7.2 million openings. And also CB consumer confidence, expected around 96.0. So snapshots of labor demand and how consumers are feeling.
But the main event, the one everyone's really waiting for, holding their breath for, is Friday morning, right?
Absolutely. Jobs Friday, that's the big one. We'll get non-farm payrolls. The consensus there is for only about 50,000 jobs added, which is a really low number, suggesting maybe the labor market is cooling significantly.
Right.
We also get the unemployment rate expected to hold at 4.3%. And average hourly earnings, the wage growth number the Fed watches so closely for inflation pressure.
Now, here's where it gets tricky, tying back to that macro anxiety we started with. There's this hidden danger for the week. The potential for a data blackout.
Yes, exactly. If that government shutdown actually starts on Wednesday, there's a very real chance, a high probability even, that it could delay the release of Friday's big jobs report and maybe other key data too.
And the market hates uncertainty more than anything.
That's what it fears most, an information vacuum. If the market suddenly loses its main economic compass, the jobs data, especially at a time like this with all the other uncertainty, well, you'd likely see volatility spike dramatically. Investors wouldn't know if things are getting better or worse, collapsing or holding steady. They'd be flying blind, relying on pure speculation.
Okay, so that's a major risk factor tied to the shutdown. But beyond the government numbers, we also need to keep an eye on a couple of major companies reporting, right? Bellwethers that give us real-world economic color, regardless of data delays.
Definitely. Two key ones. First is Nike, NKE. They report Tuesday after the market closes. As a huge global brand, a Dow component, their results are always seen as a bellwether for consumer spending worldwide. We need to hear what they say about inventories, about demand, especially in China.
Okay, Nike for the global consumer. And the second one gives us a view of small businesses.
That's Paychex, P-A-Y-X. They report Wednesday morning, before the market opens. Because they provide payroll and HR services to tons of small and medium-sized businesses all over the country, their report gives one of the best ground-level views of hiring trends and wage pressures among smaller employers.
So look to Paychex's outlook to see if that expected labor market softness is actually showing up on Main Street.
Exactly. It's a great reality check.
All right, let's try to wrap this up. Let's synthesize everything we've unpacked from this morning's brief. What's the final word on this market tug of war?
Well, the synthesis is, I think, that we're in this state of sort of fragile, cautious optimism. It's driven by that continued strength in tech and these very specific micro-level catalysts we talked about.
Right.
But it's being seriously undercut by really high macro anxiety, primarily the shutdown threat, and this extreme dependence on upcoming data that might not even arrive on time. The market is fundamentally fighting with itself about what the right level of risk is right now.
And for you, the listener, what's the strategic takeaway? How do you navigate this contradiction?
I think the message coming from the market to corporate America is pretty harsh right now.
Yeah.
It's absolutely a show-me environment. The market demands that impeccable forward guidance we discussed, not just good historical numbers. Just being a strong company isn't enough to fight off the macro weakness unless you can translate that strength directly into a raised future outlook.
If you don't beat and raise.
You get punished. Simple as that in this environment.
Okay, and quickly, what are those key levels we need to watch? The signposts that tell us whether the macro fear or the micro hope is winning out.
Two critical levels, I think. First, the VIX futures. Keep an eye on that 1718 level. A sustained move above there signals the market is genuinely pricing in serious disruptive shutdown risk, and you should probably expect more selling pressure.
Got it. VIX above 1718 is the warning flag.
Second, the 10-year Treasury yield. If that yield starts creeping back up above 4.20%, that relief we've seen for growth stocks is likely over, and pressure comes right back onto the tech sector.
So VIX and the 10-year yield, key indicators.
The core takeaway from this deep dive seems so striking. You've got this simultaneous surge in high-flying risk assets tech, these speculative crypto plays, and the ultimate safe haven gold hitting record highs. It tells us investors, particularly institutions, are hedging aggressively against really bad outcomes, even while making short-term bets on things working out okay. So what stands out most to you in this contradictory picture? As you head into the trading day, are you focused more on those exciting micro-catalysts, the potential for those 200% stock gains, or are you weighed down more by the macro anxiety being priced into gold? Something critical to consider.